You probably know that investing is the smart thing to do with your money, but there's lots of potential risks that are involved with it. Like, what if I lose all my money? Won't I have to spend hours researching stocks?
Because we're now down 43%.
And when's the best time to buy and sell my shares as well? The biggest thing that I've learned over the years is that investing is not complicated. None of these things are true, but with all the news headlines that you see about constant recessions, market crashes, the falling value of the dollar, because of all of this false information, it's easy for people to become afraid of the idea to start investing.
Don't buy it. I'm out.
And I felt exactly the same way when I first started, but thanks to these 3 ETFs, I never have to do any research and I could stop contributing now and my investments would keep on making me money. Even just investing $50 a week over a long enough time period, say 30 years, can give you a portfolio valued at near $400,000. So it doesn't take a lot of money to get started and it can be a strategy easily replicated by anyone. The strategies I'm going to be showing in this video will outperform the vast majority of hedge fund managers on Wall Street. And as long as you can hit a few buttons on a keyboard, you'll be able to follow along and replicate these results for yourself. So what exactly is an ETF and why should you care about one? ETF stands for Exchange Traded Fund. Essentially, it's just a collection of different companies all clumped together based on a particular goal or a sector that the ETF is trying to follow. So you get ETFs that will track real estate, finance, healthcare, renewable energy, small, mid, and large cap stocks. There's a whole variety of different ETFs on offer, but most notably, there's ones that will track the overall performance of a country's stock market. Now, the biggest and most recognizable one in America is the S&P 500. So this is just a collection of the 500 biggest publicly traded companies in the US stock market. It accounts for about 80% of the total US market itself, and it includes a lot of the big players like Coca-Cola, Amazon, Facebook, Tesla, some of the largest companies in the entire world. So the great benefit of ETFs is that it's a low-cost way to get exposure to various different companies. So as an example, with the S&P 500, as the name would imply, it's made up of 500 different companies. Now, if you're on a broker and it say costs $2 per investment, if you wanted to actually go out and individually buy all 500 of those companies, it's going to cost you $1,000 versus making one single investment into an ETF that tracks that index. You'll get all 500 of those companies for a one-time investment of $2. And say you put $1,000 into that ETF, then you'll be getting exposure to various different companies and you'll have wide diversification in your portfolio. You're not going to be at the mercy of one business on its own. Let me know down below in the comments what your favorite ETF is. I make sure to reply to everyone that comments on my channel and I really enjoy interacting with all of my viewers. So those are the main driving factors that make ETFs so popular. They give you access in a cheap way to various different companies, you get wide diversification, and you also get a very consistent return. The S&P 500 has been giving a consistent return of 10% since the 1950s, making it one of the most popular ETFs that money can buy. From a very young age, I've always been someone that was interested in money, but through my high school years and most of the time I was at uni, I didn't really know the best way to actually make my money work for me. I always just thought, get a good job, save every penny you can, live below your means, and then everything else will take care of itself. But at uni, one of my friends introduced me to investing and I had tons of questions and I was very confused in the beginning, but over time I would spend 2 hours every day researching in the uni library, reading tons of books, listening to podcasts, searching up all my questions on YouTube, watching countless videos, trying to just absorb as much information as I could. I was looking for the secret formula, the winning ticket to buy the best stocks that were going to make a massive jump in price in the shortest space of time, pretty much just looking at investing like gambling. And over time, I slowly came to realize that ETFs were going to be the most strategic thing that I could do. It wasn't going to be fast money, but over time, it was going to make me the best returns and it was going to help me avoid a lot of the traps that can come with investing, like just buying into hype, looking for the next GameStop or AMC, and just following what everybody else is doing instead of what's actually proven to work. I found that I was really overcomplicating things and making investing a lot more difficult than it needed to be. I was still looking for the magic formula, thinking that I had to find the next best stock that was going to take me to the moon and quickly chop and change between different investments. I couldn't believe that some of the biggest investors in the world, like Warren Buffett, were actually recommending a buy and hold strategy where you held on to the same investment for decades at a time. And ultimately, this was a far easier approach than what I thought investing actually was. So after looking into ETFs more closely, it's what I ultimately thought was going to be the most effective vehicle to help me reach the goals that I had financially in the stock market. One other investment that you can make for outstanding results is subscribing and quite literally smashing that like button. The three types of ETFs that I'll be covering in this video are one that has a high dividend yield, one with a high consistent return, and another with a rapid growth. This will give you a few different investment options so you can have a balanced portfolio. The first ETF on this list is SCHD, or the Schwab US Dividend Equity ETF. This tracks the Dow Jones US Dividend 100 Index, which is just a collection of the best 100 dividend yielding companies in the US stock market. SCHD has a dividend yield of 3.4% and it's paid out every 3 months. So if you had $10,000 invested, every 3 months you'll be getting $340. So this means over the course of 1 year, you'll be getting $1,360. Over the past 10 years, it's had an average return of 1.17%. This means if you had invested $10,000 10 years ago, your portfolio would be valued at $37,628. The reason I like this ETF so much is because it lets you get exposure to multiple different dividend yielding companies that have a very strong performance. You're not at the mercy of one single company on its own, and it pays out a dividend every 3 months. So you'll be getting a dividend payout 4 times a year with SCHD. Relying on one single dividend stock can be a little bit risky. Even very established ones like Disney did have their dividend cut during the COVID pandemic. So you can't always rely on a single company on its own, even if it has been around for several decades. It has an expense ratio of 0.06%, meaning for every $10,000 you invest, you'll be paying $60 in fees. It has $42 billion in assets under management, and it's made up of 102 different companies. Some of its top 10 holdings include Pfizer, PepsiCo, and Coca-Cola. When I first started investing, I was always quite anxious, constantly checking my phone to see if I had lost or made money, and even if I had made money, I was still worried about losing it. I always got into investing to save time and to have more income for myself, but I really felt like investing was just taking up all of my time and energy. But the more I got into ETFs, the more I preferred them over individual stocks. Don't get me wrong, individual companies can make you a lot of money, but there's just something that can't be beaten about the consistent gains and how reliable ETFs can be. When I first started, it was kind of addictive, always checking my phone. It was the first thing that I would look at in the morning when I had woken up to see if I had made any money through my investments. And ETFs were a much more hands-free approach, and I really felt like I was getting my time back and not having to spend so much effort and energy always seeing if I had made or lost money in the market, because I knew that they were reliable and I wasn't at the mercy of one company to try and make me money. The second ETF on the list for consistent gains is VOO. This is a ETF made by the company Vanguard, and it seeks to track the performance of the S&P 500 index. So as you're probably all familiar, VOO tracks the top 500 biggest publicly traded companies in the American stock market. So all of the top 10 holdings and the vast majority of companies in this ETF are very recognizable and some of the biggest businesses in the world. Some of the top 10 holdings include Google, Coca-Cola, Tesla, Apple, and all of those other big names. Some of the biggest sectors in the ETF include information technology, finance, and healthcare. Essentially, with VOO, you're just making a bet that the American stock market will continue to grow and be profitable, which historically it has been doing for hundreds of years. So it's a pretty very safe bet to make. All of the companies in VOO are firmly ingrained within society. If you're buying a phone or using a laptop, you'll be purchasing an Apple product. Coca-Cola is one of the biggest and most recognizable soft drinks. Everybody has to use the internet, and what search engine do you have access to? Of course, it's Google. So the vast majority of companies are a staple within society. If you're buying something online, you're going to purchase it through Amazon. So if for whatever reason VOO collapses, then the whole world as we know it will most likely have collapsed as well, and you'll have bigger problems than trying to get your money back that you had lost in the stock market. Over the past 10 years, it's had an average return of just over 13%, meaning that if you had invested $10,000 10 years ago, your portfolio would be valued at $34,826. It also has a dividend payout of 1.59%, so for every $10,000 invested, you'll be getting $159 paid out annually in dividends. Warren Buffett, who is considered to be the world's best investor, says that an ETF that tracks the S&P 500 should be a staple in anyone's portfolio. It sounds like the perfect investment if even Warren Buffett is recommending it to people.
Sweeteners. That's a 10.
But what are the downsides? It seems too good to be true, and there have to be some risks with it. The biggest limitation is that this ETF won't make you rich overnight. It's not going to be as exciting as finding the next GameStop or Dogecoin or SafeMoon, but what it will do is give you a very straightforward way to make money in the stock market. The key thing here is time and consistency. The longer that you have your money invested, the more time it has to grow and compound. And with this, you're thinking in a 10, 20, 30, 40 year time period. The longer you have your money set aside, the more it's going to gain value over time. So as you can see on screen, this is how much money you would have to invest based on your age, assuming that you're going to retire when you're 65. So the more time that you have, the less money you have to put aside. And of course, the less time you have, the more money you have to put in to reach that final goal of retiring with $1 million. I always thought that you had to find the next best investment to make money. While of course you can see some massive gains if you get into something like GameStop nice and early, but in the long run the price always comes crashing down. It's like catching a falling knife. You can make money, but the likelihood of getting too greedy and holding on to the investment too long and ultimately losing what you initially put in is very high. Human emotion isn't the best thing to rely on when it comes to investing, so I always try and remove that as much as I can and just have it be more of a methodical process, always having a set amount of money that I put in each week no matter what, and have it go into an ETF. VOO has an expense ratio of 0.3%, so for every $10,000 invested, you'll pay $30 in fees, and the total market cap of the ETF itself is $470 billion. Next is VGT, or the Vanguard Information Technology ETF. This essentially tracks the best companies related to information technology, and it's the best growth ETF on this list. Over the past 10 years, it's had an average return of 18.85%, meaning that if you had invested $10,000 10 years ago, your portfolio would be valued just over $56,000. Along with this impressive return, it even pays out a dividend of 0.87%, so for every $10,000 invested, you'll be getting an annual dividend payout of $87. The ETF includes a total of 367 different companies, and some of the top 10 holdings include Microsoft, Apple, and Visa. The main sectors of the ETF include hardware, software, and technology. People might criticize VGT for focusing mainly on the technology-based sector in the market, which historically tech stocks don't do that well during a bull run. However, if you compare the downtrend of VGT over this past bull run that we've had, it's come down 27% in comparison to VOO, which is more of a representation of the total stock market value. It's only come down 17%. So there's a 10% difference between the drawdown during the most recent bull run that we've had between VOO and VGT. So overall, VGT has remained quite consistent, and you might hear people say that tech stocks are overvalued and they're due for a correction. Whether or not that's true and going to happen, I don't know myself, but just do keep that in mind when you're investing into an ETF that focuses largely on one specific sector. Knowing what dividend stocks to buy is very important, but you also have to know the best strategy to maximize your dividend returns. Check out this video on screen that'll show you the best strategy to actually retire from your dividend income. Knowing this information is very important because dividends are a truly passive source of income that can quickly stack and compound if you know the right strategy when buying dividend yielding stocks.